Let's talk first of all about region by region strength, weakness. I mean, what is the evolving picture of demand as we know this is one of these kind of gold rush moments in the country?
Sure. So we're supporting 5,000 customers across 50 metropolitan areas on 6 continents. Traditionally, the outside the U.S. markets were growing faster than the more mature U.S. markets. With the advent of artificial intelligence, that incremental wave of demand, that's kind of come full circle. And our North American market has been our largest contributor to our growth recently. We're bringing on new capacity in Northern Virginia, Dallas, and other major metros across the U.S.
So you are, because in the results, or there was some question and answer about no activity in Northern Virginia, stronger performance in Dallas, and there were some questions about the revenue decline overall. What is that attributed to?
So we had a called top 2 quarter when we included our partner shares and new signs on the heels of a record, and our new signs are up double from last year at the same time. Dallas led the way, which is the demand is broadening out from the traditional markets. The good news is Northern Virginia, which represents about a quarter of our business and our largest market, we have large capacity blocks, and that is the most precious market. So we've got called $3 billion of data center investments coming online with customers queuing up for that capacity.
So in other words, we're just seeing lumpiness in the flow of business. Is it seasonal or is it?
Definitely not seasonal. These are secular long-term demand trends. I think the topic of Northern Virginia came up that says the quarter was pretty darn robust even without Northern Virginia. But just wait a quarter or two, I think that'll be back on the charts as one of our top contributing markets.
So when you look at this and you know, I mean, a lot of the stuff about AI is hype, but a lot of it is real, I mean, dollars. The size of NVIDIA's growth over the past couple of years is flooring. So where do you think we are in terms of the amount of money being thrown at this and what the next 12 to 18 months might bring?
So we look at what we're doing we're the physical manifestation of the AI. We're converting that to recurring revenue, long-term contracts with most established customers out there. We're focused those 50 metros where there's core demand from a diverse set of customers that are already doing digital transformation, cloud computing inside our data centers and want to grow with us. And lastly, it's happening at a time while supply is more constrained now than it's probably been in 20 years of the data center industry.
Why is that?
Power generation, power transmission, sustainability concerns, navigating all these elements while this growth is happening at rapid scale.
I was just thinking about kind of the past in the terms of partnerships that big tech has had. You know, you look at companies like UPS and FedEx. Well, they were once a huge beneficiaries of big tech until big tech just said no. Like Amazon said, we're just going to have our own fleet. You know, would big tech say, okay, we're looking down Amazon loves to look down the balance sheet, take a cost center, turn it into a profit center. Is there some way they could do that and disrupt your business, or try to take these things in-house somehow?
So we're supporting 5,000 customers, but our top customers are called the household names of technology. They certainly have abilities to bring on capacity and operate their own data centers, and some of them do it. But in these major metros where we have gigawatt land banks of capacity to grow, where we can support them from South Africa to Ashburn, Northern Virginia to Singapore, we are a value add and a force multiplier for their growth.
So what would you say about the power market then, where I look at nat gas prices? I don't know if they went to have a one handle yet, but they've been extremely low. That's got to be helpful for some parts of the grid that are more reliant on that. Others, and especially big tech, as we know, is so prioritizing renewable energy. So when you're looking to kind of meet their demand and what power characteristics they're looking for, how are you able to get that at a decent price or not?
So I think I shared this with you last time I was on. Power is a pass-through to the customer in the end of the day with our contracts. The customers want more power as fast as possible, and they want green and sustainable power. At Digital, we're leading the way, pushing more and more power to green, entering into long-term agreements for the creation of wind farms, solar farms, not adjacent to the data center. That usually doesn't economically work out, but greening our grid, greening our power. And we're trying to do that at, call it, hyperscale growth for these customers.
But you're basically just, they pay the bill for that. So whatever it is that they want, you can deliver it to them somehow, and the cost just is whatever the cost is.
You got it.
What is then the competitive difference between working with your company versus a number of the other major competitors out there?
So those top customers I mentioned, 40, 50, 60 different locations around the world, one-stop shop in terms of what we can deliver to them. And we're delivering it from small footprints to the largest footprints in terms of data center land.
Yeah.
And we've been doing this for 20 years, solely focused on delivering digital infrastructure.
It's fast. But I'm just curious, does it make a difference? So for if my company is based in California, does my data center need to be as close as possible? It reminds me of the high-speed trading, where the co-location. I mean, how important is proximity for stuff like this?
Not to the extent of what you're thinking about with high-frequency trading, but we're focused on markets that have diverse and robust demand that are locationally sensitive workloads. The data needs to be proximate to the GDP, the population bases, the consumers of the data, and that interact with it. And these are markets that are becoming more and more supply constrained given their major metropolitan areas.